The 1031 is actually the greatest wealth building tool in the entire Internal Revenue Code.
Especially if your objective is long-term cash flow, passive income.
So the 1031 allows you to pivot as your objectives change to that type of real estate without having to pay the tax. It's the IRS telling us, hey, here's how you can use a 1031 exchange to buy your dream home that you want to use for personal use.
I've done 1031s, I've dealt with them over the years. I think that how dynamic they are and the different avenues you have is something I really got today.
A qualified intermediary is the official term for what we are.
All right, hey everybody, Cory Meyer here, Cory Meyer Real Estate. I'm here with Russel Marsan, the Senior Vice President of IPX 1031 Exchange. We're here to talk about 1031 exchanges, what they are, how to go about them, and why you would use them, right?
Yeah, absolutely.
So excited to have you up here. We got lucky, he's actually up in Reading today, so we've got a list of questions we're gonna fire away at you. And I'll start off with, tell us, what is a 1031 exchange? Who should consider it and why?
Yeah, great question. The 1031 is actually the greatest wealth building tool in the entire Internal Revenue Code because it allows a real estate investor to reposition their real estate assets throughout the course of their entire life without having to pay tax, right? A real estate investor, it's just a natural progression that as they grow in life, their financial objectives are going to change, right? Early on, you want to build wealth, so you buy properties that are going to appreciate. Later on in life, you own a bunch of properties, you have a lot of equity. Well, now it's time to pivot to cash flow, right, to maximize the income. Later on in life, you're tired of the headaches of real estate, so now you need to go passive. Those are all different types of objectives. So the 1031 allows you to pivot as your objectives change to that type of real estate without having to pay the tax. And in a state like California, the tax is pretty hefty.
Yeah. Oh, it can be.
Yeah, absolutely.
Yeah, well, so what does it cost to do a 1031 exchange? And then also go into what type of properties can you or can't you do a 1031 with?
Yeah, so first cost, we're actually an unregulated industry, which people have to be careful with. And so it's kind of like the wild, wild west out there in pricing in 1031s. We're the largest intermediary in the nation. So all we do is 1031s, and our parent company is Fidelity National Financial. So we're the most financially secure and stable company in the entire industry. And I've been doing it for 29 years, so they're in great hands. But we have a simple flat fee structure, our company. So when they close escrow on the relinquished property, there's going to be a $1,000 fee charged and taken from the closing proceeds. When they buy a replacement property, the fee on that end is just $250 when it closes. Simple. That's it. $1,250 total cost, sell one by one.
Nice.
Yeah, that's it.
What are the biggest tax benefits of doing a 1031?
A lot of people make the mistake of not consulting with their tax advisor or myself before they actually sell an investment property. And in their mind, they're thinking, hey, I'm gonna pay like 15% because they've heard that capital gains is 15%. Yeah, that's not the case. In California, the average tax is closer to 35%. Yeah, when you blend in depreciation recapture, capital gain, and the affordable healthcare tax, the uppermost tax rate in California could be 40%, over 40%. So a good average is about 35%. That's a lot.
Yeah.
So you just want to make sure you know.
So they're going to eat 45% of their gains.
Yeah.
And right off the top, if they were to just sell an investment property and not have an exchange in place.
Yeah, so you're giving up 35% of that growth in income for the rest of your life when you don't have to with the exchange, right? And some people are told, and I got this a lot before the election last year, that a lot of people were being told by their CPAs, don't do an exchange, just pay your tax. And the reason was because a 1031, you don't eliminate the tax when you do a 1031, you're deferring the tax, right? So the thought process is, well, you got to pay it sooner or later because it's, we all have been told two things in life are inevitable. Death and taxes, right? We've been lied to. Only one of those is death, unfortunately, but taxes are not. Current estate tax law is incredibly favorable. $15 million is the threshold on the estate tax currently. So if you're single and your estate's below $15 million, there's no estate tax. If you're married, $30 million, double that amount. And your heirs get a step up in basis. Right, so if I bought the property 60 years ago in Reading for $100,000, and when I pass away, it's worth $2 million. My kids, after I pass away, when they go on title to that property, their basis is stepped up to the fair market value as of the date of my passing. So it's stepped up to the $2 million. They can sell it for $2 million, pay no tax. They don't need to do an exchange. right? Because all of the tax was forgiven through the estate process.
Do you see any change coming with the current administration with some of that? Isn't there talks of that?
It actually, with the big beautiful bill, it did, because this year that estate tax capped out, and next year it was due to go down.
Right.
The bill now has set it at the $15 million per spouse again, and so now it'll be adjusted for inflation every year. So it's only changed to the benefit of taxpayers. Yeah, so that's pretty cool. So that's why we say, don't let your clients cash out of their real estate and pay their tax. Just help them exchange into something else that better suits their current financial objectives. Because I promise you, whatever their objectives are, there's some type of real estate that'll meet those. So,
Right.
Yeah. So
Especially if your objective is long-term cash flow, passive income
exactly.
in the
Yeah.
real estate space.
Yeah.
There's no reason to just sell and
cash out.
yeah.
Sell and exchange into that better property that better suits your current financial objectives. So
Yeah.
So that's why we say don't cash out. Instead, just exchange until you pass away. Right? We call it swap until you drop.
Yeah, that's good.
Yeah.
So there's timelines on these things when you sell a property, right?
Yeah, so timelines in the exchange begin when the relinquished property you're selling closes. Right now we have to set up the exchange before it closes. Right, they can't do it after the fact. We have to be in place before it closes. But once it closes, they've got 45 days to identify and a total of 180 days to actually close. Those are concurrent time periods, they run together. And they are calendar days, they're not business days. So if it's a weekend or a holiday that one of those deadlines falls on, it's still that date.
Okay.
Only extensions ever granted are for federally declared disasters. So that's not a common thing. So people should just assume that that's the date.
And tell us about the identification process of an exchange property. It's 3, right?
You can do more than 3 possibly. There's really 2 rules of identification which allow any exchanger to over-identify, so they'll be able to identify more properties than they actually want to buy. The 3-property rule, which is the rule you alluded to. Most people use that rule. It allows you to identify up to 3 properties of any value. That's used for people that only want to buy 1 or 2 properties in their exchange, because that way it'll give them 1 or 2 backup properties to default to, right? Some people go into an exchange knowing, hey, I'm going to buy 4 or 5 properties, because they're selling something expensive and buying smaller ones, right? In that case, they use what's called the 200% rule. 200% rule has no cap on the number of properties. You can identify 10, 20, as many as you want, but it does have a cap on the total value, right? The aggregate value of everything you identify can't exceed 200%. 2 times the value of the property is sold. Sold for $2 million, you can identify $4 million, no matter how many properties that consists of. One of those 2 rules work for every single client.
So if you're buying a property, if you're selling a property at $1 million, you can't go buy over $2 million.
Well, you can if you use the 3-property rule.
Okay.
Right, because the 3-property rule has no cap on the value.
Got it.
Right, so those rules are kind of juxtaposed to one another. The 3-property rule has a cap on the number of properties, but no cap on value. 200% rule has a cap on value, but no cap on the number of properties.
Okay. Can someone exchange into multiple properties? Obviously, you just said yes. Can they consolidate properties into one?
Yeah, in fact, a very common retirement strategy is that. You're a retired couple and you own 5 rental properties free and clear. And you're like, I'm just tired of dealing with the headaches of owning single family rental properties,
Yeah.
especially in a state.
My folks like to do that.
There you go. Especially in a state like California, right? We're not a landlord friendly state. Shocker.
Yeah.
Newsflash, right? So, so a common strategy for them is to consolidate, right? Sell the headache single family rental properties and buy into one commercial triple net lease property, right? Because that's designed for cash flow. That's designed to go passive, right? Whereas you're labor intensive on the single family side, owning rental properties, and cash flow is not good, right? Single family properties are designed for appreciation, not cash flow. Commercial triple net, that's designed for cash flow and to go passive.
Right.
So they're in the wrong asset class. And if they don't want to buy their own property, then they can always go into the DST, the Delaware Statutory Trust,
Right.
which is a very passive form. That's the most passive form of real estate ownership.
And we're going to ask this question about crossing state lines, but just for example, if I own a property if I own 6 properties in Reading,
Yeah.
I want the passive income. for retirement, but I don't want to deal with any of the junk that comes along with being a landlord. I want to buy into a DST, say in Dallas, Texas, that's buying a 360 unit complex. What does that look like?
At any one given time, there's between 30 to 50 different DST offerings that are available, and these are all institutional grade assets. So they're 100, 150, $200 million class A asset.
Right.
It's an Amazon distribution center, a very large climate-controlled mini storage, huge multi-family like you're talking about, senior care facility, student housing on a major university, that kind of stuff, right? And yeah, it's just passive ownership. It's just you own a small slice of that and you just receive income every month. You have zero duties or responsibilities. There's no phone calls, no headaches, no cash calls are allowed, which is one of my favorite things. That means for maintenance of the property, they can't ask us for any money, right? So there's no outflow. It's just income that comes in automatically in direct deposit into my checking or savings account.
Nice.
Yeah.
How are you seeing the returns on that compared to just having your own?
You know, I'm going to compare it against single family, right? Single family, a lot of people are under the misconception that my single family rental properties are earning 10% cash flow a year. That's 100% false, right? Because you have to really analyze it. It's not the gross income, it's the net income after all expenses, right? You take that number, divide that by the value, that's your actual return. And typically that's 3% or less in California. These types of assets like the DSTs, it depends, there's different offerings and different asset classes, but 4.5% to 6% is the cash on cash, which is a net number coming into you after all expenses or whatnot. And the IRR, the total, internal rate of return, it's typically double digit between the equity and the cash flow.
Yeah, I know there's like multiple tiers you can buy into for preference.
Yeah.
On the returns too with some of these DSTs, right?
Yeah, because there's different types of asset classes and even oil and gas leases, right? You can exchange into that. That might be throwing off 8%, 10% cash flow. So there's different asset classes within the DST realm.
So it's super interesting, this topic. So like, what are you seeing right now if you don't want to exchange into another rental property? Because we were talking about this earlier, the amount of baby boomers that do not want to deal with being a landlord, but they're the largest, real estate ownership class in America.
Absolutely.
What are you commonly seeing them going into for investment to get away from the tax, that 40% potentially, and get that passive income without the headaches?
The DSTs, by far and above. Because they want to retire and they don't want to own their own property by themselves. And plus, they're familiar with single family rental properties. That's what they've owned. They're not familiar with triple net lease commercial. So in this case, they're going to hitch their wagon to a multi-billion-dollar corporation that has been doing this for 50 years. They just got to go along for the ride instead of having to do it for themselves. So by far the DST. But what I see is there's so many, and you bring up a really good point, that demographic, the population, right? Only about 20% of the United States is baby boomers, but they own over 41% of the residential real estate. That's a big number. A lot of those baby boomers are sitting on single family, and it's the wrong asset class. They just don't know it. So somebody needs to tell them, hey, you're in the wrong asset class. You need to be in triple net lease commercial, right? Somebody needs to get that word out to them.
What about like a 35-year-old? What are you with your experience saying to them? Exchange into a DST, or because the returns aren't there, or what are you saying?
No, I mean, I think what you're describing is somebody that's trying to build their wealth, right? So I would not, DST is you've built your wealth and now you're trying to maximize the income and you want to go passive. If I'm still young, 20s, 30s, even 40s, maybe into the 50s, I'm still trying to go through 1 or 2 real estate cycles and either double or triple my equity, right? I'm trying to build that wealth. That's not, a DST will appreciate, but that shouldn't be the primary. Single family, it's fantastic to do that, right? That's still good. Or multifamily 1 to 4, that kind of stuff. People get in, it's whatever's affordable. Typically that's single family initially.
It's a tough thing to find right now.
Nowadays it is, but,
but
still
affordability is nuts.
It's still typically single family, right? Based on everything else, all the asset classes, right? So you get into a single family however you can, and then after a couple of years, you leverage that into something else, a little bigger and better. Or you start to go multifamily, right? You start to kind of build your empire. But the key component is get that first property, right? Get into the game. The like kind is a misleading term, right? Everybody's visual and they think, well, like kind means, If I sell land, I have to buy land, sell a house, buy a house. That's not true. Like kind isn't what a property looks like. It's how it's treated for business purposes or tax purposes, right? Any business or investment property is like kind. So you can sell raw land, a 5-acre piece of land that you have no income and you can't take depreciation on it. Right? So you have 5 acres of land, you can exchange that into your first rental property. They are like kind. Right? So you go from a negative cash flow vehicle, you're paying insurance on it, you're fireproofing it every year, you're paying property taxes, it's outflow. You can take that stagnant equity, buy your first rental property.
Yeah.
Right? Now you have cash flow.
Because they were both investments.
They're both investment properties, right? So they are like kind. I can't count the number of times I've had tax advisors tell my clients over the years, you can't exchange raw land for improved property. It's not like 100% false.
Yeah.
Never been true, right? And that's why 1031 is such a powerful wealth building tool. Because if you look at all the different asset classes in real estate, land, single family, multifamily, industrial, commercial, all of them have different financial objectives. And as your objectives change, the 1031 allows you to pivot, right, to that kind of asset that better suits. It's all like kind.
So you can go from commercial to residential as long as it's like kind.
Yeah.
But what if you are selling your personal residence and you've been claiming a home office in your home on your taxes every year and for business, and you have an ADU out back that you've been renting out?
Yeah, great question. Little known fact here. A lot of people, they're selling their primary residence and they're within that 500,000, right? So they think, oh, it's going to be a tax-free sale to me, my primary residence. So they don't consult their tax advisor.
Right.
Right. Well, if you have any kind of business use in your home, your primary residence, so if you've been claiming an in-home office, like you said, right? Who's been doing that since COVID? A lot of people.
Yeah.
Right. If you rent out an ADU, if you rent out a bedroom on Airbnb to traveling nurses, right? Those are all business uses. If you're claiming that on your taxes, you're taking depreciation. Right? When you sell an asset that you've claimed depreciation on, which is a great tax benefit, you're always recaptured on that tax.
Right.
And it's punitive. In California, that's around a 35% tax. So if you've taken $80,000 of depreciation against your primary residence because it had a business use in it, then you're going to be taxed on the $80,000 at 35%. That's a big chunk. Right, so it actually qualifies as a mixed use exchange. So part of the primary qualifies 1031 because part of the primary is business use. So I always recommend that people, if you have had any kind of business use in your home, ask your CPA, what's my tax hit gonna be when I sell this primary? If they come back and say, oh, you're gonna pay like $2,000, no big deal, don't do an exchange, just pay your tax. If the CPA comes back and says, you're gonna pay $80,000, oh, okay, well, you have the option now to do a 1031 on that portion of your primary.
Just that portion.
Just that portion. So if you write out 15% of the house, because it's a bedroom, right, that you claim, okay, 15% of the sales price needs to flow through at 1031. 85% will come to you just tax-free at closing as your primary residence exclusion.
Challenge is you got an $80,000 tax base now. You have to buy a property for more than the $80,000, correct?
Yeah, but
So you're gonna have to buy your $80,000 turns into a $400,000 purchase maybe.
Yeah, but it's only a portion of it, right? It's not the whole purchase.
Right,
So
you have to make the purchase though.
yeah, but
Or like kind.
in a lot of cases, you're buying another primary residence and you're gonna have another in-home office. So the numbers probably jive. You can do the 1031 in your primary. And if
They'll take the portion of that new purchase primary residence and say, okay, this guy or gal, he was already doing 15% of that allocated to his home office.
yeah.
We'll exchange into 15% of that purchase.
It's not always necessarily going to be the 15 and 15, right?
Right.
So, but let's,
Sorry.
15% of the relinquished property they sold, the primary, equates to 80,000. We're just making this number up, right?
I see, yeah.
So now they take the 80,000 and they say, okay, here's the property we're buying that's a primary residence. What percent is $80,000 of that property, square footage wise? Okay, now I have to justify that much business use in the property I'm buying. And that's just it's just, an exercise with their CPA. The CPA says, yep, I like it. 2 bedrooms equal that. We can definitely write that
We
on.
run this scenario by you.
Okay, I love it.
This is all
challenge.
good
Okay.
stuff. So
Good stuff.
I have my primary residence, okay, and I have a shop, small, super small auto shop in town. I want to sell both of them, and I want to buy this awesome property with 15 acres which also happens to have a shop, or I may build one to house my auto business and bring it all home under one property. How would that all work?
Same concept. So what we've been talking about here is what we call a mixed use exchange, right? It's one property, but it has multiple uses to the owner. Part personal because they live there, part business because they have a shop or whatever, or claiming an home office.
Right.
So it's the same thing, right? So if you're, give me a fake number.
So, okay.
Sell the shop
so
for how
I'm
much?
selling the shop for $250 and I'm selling my current home for $500.
That doesn't matter. Let's just talk about the 250 shop.
Buy this property
Okay.
for $1 million.
Okay.
That has total setup area for my auto shop.
Okay.
And I have the house of my dreams.
Okay, here you go. So you sold something for $250.
Yep.
That was a business use property. So therefore, to satisfy the exchange and to defer all tax, you have to buy some kind of business use property worth at least $250,000.
Yeah.
If you buy $1 million property, you're just going to have to be able to justify $250,000 of that property to be used for business use. So 25%, right? If it's got acreage, the acreage counts.
I think it's a super exciting concept.
100%. Yeah.
You know,
that people don't know about.
You know, for example, I just met with a client. They have a trucking business. And they're in a super small subdivision, great house. They want to sell that house and they need to buy a bigger property with a shop to house the trucking side of things.
Are they going to be selling another 1031 property also, or just their primary? Because if it's just their primary,
no, but let's just say they owned a lot that they parked their truck on. They should sell both of those assets, combine them into the new purchase.
Yep.
Interesting stuff. I think this is all, unknown stuff that people don't think about. Like, that's very interesting to me to think about the ability to sell two properties and find a business use on your property and allocate that 1031 exchange money into that purchase of your dream property.
Yeah, absolutely.
Super cool idea.
Now, so let's say they own a couple rental properties and they'd love to sell those rental properties and buy their dream home on the lake up at Lake Almanor or in the ocean or somewhere, right? Well, it's personal use properties don't qualify 1031, right? So you can't buy your primary, but what you can do is go through a conversion process. The IRS in 2008 created my favorite revenue procedure. It's Revenue Procedure 2008-16, and it is an actual recipe. It's the IRS telling us, hey, here's how you can use a 1031 exchange to buy your dream home that you want to use for personal use. All right, so here's what you do. You sell your investment properties, do a 1031 exchange, you buy your very expensive dream home all cash. For the first 2 years, and this is the time period, for the first 2 years, you have to treat the property two ways to satisfy the business use intent for the exchange. First 2 years, do two things. One, limit your personal use in the property to 2 weeks a year or less, or 10% of the rental history, whichever is a bigger number. And if you're going there to maintain the property, that's not a personal use visit. So there's ways to use it for more than 2 weeks a year. And then the second thing you have to do is show income on it. But that's a really low standard. You only have to show 2 weeks per year of income on it. That's it.
Really?
Yeah. So you can do that for 2 years. And if you don't need the cash flow and you don't want tenants in your dream home, then all you have to do for the first 2 years is limit your own personal use. Find a best friend to rent it from you for 2 weeks a year. I'm gonna claim the 2 weeks a year of income on my taxes. It doesn't have to be on VRBO or Airbnb. I just have to show 2 weeks a year of income on my taxes.
Probably don't know how many times you visit the property either to check in on it.
That's between them and their CPA. so then after 2 years, they can do whatever they want. They can move into the property.
Really? So then you're deferred, but what about the tax gains that you've had?
It's deferred. It's in that property.
What if I own a property I 1031 into and I want to use it for my personal residence? So you're saying in 2 years, you're allowed to move into that property.
And the IRS is 100% okay with it every single time if you wait the 2 years. And converting it does not trigger any kind of tax. It's only if you sell it in the future, right? That triggers tax.
So walk with me through this one because I think people are going to want to know this.
Okay.
So I own a commercial property. Let's just use me as an example.
Okay.
I'm selling the commercial property I have downtown ready, right? Because I love my new office that I bought. So I have a huge tax base on that. I know of a house maybe that I want, right? Okay. It's just bigger and better than my current setup. 1031 exchange my office building into that house, right? I can fix it up, Airbnb it for only 2 weeks in the first 2 years.
Each of the first 2 years, yep.
Each of the first 2 years. Then I could move into it. Now I've deferred all that the taxes that I would have had to pay.
Right.
And then I could resell my personal residence.
You mean the one you just moved out of?
Yeah.
Yep, okay.
And let's say I used a loan to buy that other property. Now I could resell that, defer, or not pay capital gains on that because I've been there.
Yep.
And then pay off that other house.
Sure. And now you own this other home you're moving into free and clear.
That's a
huge,
powerful move I think a lot of people don't know about.
They don't know at all. Yeah.
Yeah.
In fact, that's one of the questions that I encourage, realtors to ask their clients is, hey, in the next 2 years, are you thinking of moving to another primary residence or buying a second home or vacation home anywhere in the country? Because if the answer is yes, you've got these investment properties over here. You should list and sell those. We can buy the dream home now, season it for 2 years, and then you move into it. And you sell it, like you said, sell your primary, pay no taxes, pay off the debt, whatever.
That's incredible.
It's a great strategy. Not a lot of people.
Yeah, wow.
What's really common now is the crossing of state lines.
Yes, we were going to talk about that.
Yeah, so, I doubt.
talk to 50% of my conversations a day, I swear, on moving out of California in the next 2 to 3 years.
Yeah, I've been seeing it, the great exodus, right? I've been seeing it in my industry for about 14 years. It's real and it's happening, but what I see is 1031 is federal. Right, so you can sell in California, buy anywhere else in the United States. You will defer federal and state tax. California recognizes the 1031 just like every other state. But what I see is a lot of people just leave the state personally. What I mean by that is they sold their primary residence here and they moved to Alabama and they bought a primary residence there. They still own a bunch of rental properties here. And, right. And my question to them is always, why? And the reason is nobody's told them. You can 1031 out. And nobody actually wants to manage properties from 2,500 miles away. It's just nobody's told them, right? That you can exchange out. You can sell your investment properties in California, move them closer to you in Alabama where you now live, right? And the math works out 100% of the time. You can sell one property in the greater Reading area and probably buy about half of Alabama. You can own the whole Bama.
I don't know anymore. I'm seeing these prices.
Yeah.
It's just crazy everywhere now
Because
of all the California money.
100%, yeah.
So there is no negative to 1031 exchanging across state lines. People just think they can't do that.
Well, they think that the Franchise Tax Board, California, doesn't recognize the 1031, or they think that California's going to take their tax if they do a 1031 exchange, and it's not the case. Although, to be fair to all the listeners, California does have a unique provision. Of course they do. Shocker. It's called the California clawback, right? Like you have talons and you're clawing something back. So if you do sell a property in California and you decide, I'm going to move out of state, like Nevada, right? I want to go to a no tax state like Nevada. And then the thought process is, well, I'll do an exchange out of California in Nevada, then I'll move to Nevada. And then when I eventually sell in Nevada, I won't have any state tax, right? I'll just have to pay the feds 15 to 20%. It's not the case. California watches you. Every year, California allows you to leave and not pay the tax and defer the tax into that other state. But every year at tax time, as a Nevada resident, you're gonna have to file what's called an informational return with the state of California. It's it's a couple pages, not that big of a deal. You're basically just telling California every year I didn't sell the property. Because the year you do sell it, if you just cash out, which means you're not doing another 1031, right? If you just cash out, you owe California the tax that you left the state with in that year. If you never cash out.
So when you go cash out in that Alabama property, you're sending a check.
You're sending a check to California. But if you never cash out, so if you decide you're gonna sell Nevada 10 years later and buy in Alabama, okay, great, just do another exchange. Because as long as you keep deferring it, California will never collect that tax. And to eliminate it, you can die. It works every time. So death is the answer. Because California doesn't have an estate tax. So it is forgiven to the estate process.
Yeah, okay. Just real quick, tell them why they have to hire you. You need an intermediary.
Yes.
Right? Is it called a custodian?
A qualified intermediary is the official term for what we are. In order to execute a 1031 exchange, somebody has to act in that capacity as a qualified intermediary for you. A taxpayer can't do it themselves, because a taxpayer cannot have control of the funds in any way, shape, or form, right? So what happens is we have to assign into their escrow on the property they're selling before it closes. We're creating the assignments. We're signing in as the seller on behalf of the exchanger. That gives escrow permission to send funds to us upon closing. But when those funds come to us, we put them in a segregated commercial bank account that we name the client on also, so they know their funds are safe. And then they sit there static in that account waiting for them to buy within the time frames we talked about, right? And once they find something and go into contract on a replacement property, same thing, we're assigning into that as the buyer, which is giving escrow instructions to receive those proceeds from us. All of those have to be in place before closing. It can't be executed by the taxpayer themselves. We're an unregulated industry, unfortunately, so people have to be careful who they deal with.
You're backed by one of the biggest companies in the world, as you said.
Yeah, we're a Fortune 500.
I swear Fidelity owns so many things. It blows my mind. I did not know they owned your company.
Yeah, it's a great parent company they have, because they back us. So, and they make us put into place the highest level of safety and security in the entire industry for our clients.
Well, I've done 1031s. I've dealt with them over the years. I think that how dynamic they are and the different avenues you have is something I really got today. I feel like I'm going to be able to tell so many clients different avenues and stuff that just out of this meeting. So I really appreciate it.
My pleasure. I mean, there's a great misconception, right? That a 1031 exchange is this little tiny box.
Yeah.
And the reality is, it's the greatest wealth building tool in the entire Internal Revenue Code.
Yeah.
It's just people don't understand the full scope of what they can actually accomplish with it. You can accomplish so much with a 1031 from a financial planning standpoint.
Whatever it was 10 years ago, my folks were like, we are done with being landlords. And I'm sure a lot of people or listeners are that way.
Yes.
And I'm pretty sure they just ate it.
Yes.
Taxes.
Yeah.
And had we have known about the DSTs more and stuff like that, and I don't know if those have gained a lot of ground recently. Yeah, I see I've been seeing them, and I have buddies that are launching them and everything like that. But
yeah.
They could have done without all the landlord stuff and still had the revenue they wanted.
Yeah, that's why the DST was created, because exactly what you're alluding to. Before the DST was around, what a lot of people would do that are retirement age, they own rental properties for 30 years. They're just tired of them. They can't physically or emotionally or financially deal with them anymore. So they were just selling them cash out. Their mindset was, we made a lot of money on them because they tripled in value. So let's just go ahead and pay the tax. And then they take the after-tax dollars and they invest it into something passive like a money market fund. Now they're going to earn 3% passive cash flow. You just gave up 35% to earn this 3% passive. That's what the DST is designed. So you can go passive just like that money market fund. It'll feel the same, but you're not giving up the 35%.
But it's different asset classes. You're not going to go into a investment account or something like that.
No, it's
not going to be stocks, bonds, anything like that.
It's a specific piece of real estate.
Yeah. So.
Yeah.
But you did say oil and gas.
Yeah, because that's a real property, right? So it's
you're buying into the ground that is producing the mineral rights or whatever that are giving you the return.
You're not buying the ground. You're buying the mineral rights, the cash flow streams from the mineral rights.
Real property.
Yeah, well, because real property, like kind property, is not just the real property itself. It's also real property rights.
Right.
Oil and gas, sky, right? That cell phone towers, like leases, long 30-year leases that are greater than 30 years are also like kind. Easements, all of those things are real property rights, so they're all exchangeable.
What's the best way for someone to learn? So how does one find out about all of the options?
Yeah, so the DSTs, the sale of the DSTs are regulated by the SEC. So they're only sold through licensed financial wealth advisors. So they would need to speak with one of these advisors to see what the different offerings that are open at any one given time. There's like between maybe 30 to 50 different offerings that are available throughout the United States.
You got one that you highly recommend?
I do, yeah. And you can reach out to me, your clients can reach out to me, and I can give you names and phone numbers.
Okay, great.
Yeah.
Awesome. Well, man, I appreciate it so much. This has been just tons of knowledge. I hope tons of people listen and watch this video because, it's been fantastic. And you got great energy.
I love what I do.
And they can reach out to you anytime.
Yeah, you have my cell phone number. They can call me anytime.
Yeah, and you travel. You're in the Sacramento area, right? Is your hub?
I live in Yuba City.
Yuba City,
California.
okay.
Yep, I travel throughout. I work with clients everywhere in the country, so it doesn't matter where the client is. I deal with everybody everywhere in the country, or the properties, right? But I personally travel through all of Northern California, Northern Nevada, Idaho, and Montana are the states that I go to, right? To teach classes and train and things like that, right? But I deal with clients everywhere in the United States. And they can call me anytime on my cell phone number. You know? If they call me at like 9 o'clock at night, they don't have to apologize. I'm a tax nerd, so I don't need a life, right?
All right. Well, thanks so much for coming out, and I hope everybody enjoys this. Thank you.
Thanks for having me. It's a great pleasure. Good seeing you again.
Awesome.